All right, investors, let me share a quick update. I built 3 calculators for you. For now, I have 2 calculators. It's a DCF fair value calculator and the Piotroski score calculator. So let's start with the first one. I'll drop the link to my website in the description section. So the first calculator is the stock target price or stock fair value calculator. It consists of 2 parts. These are your assumptions from the left side, and from the right side, these are your results. First, you choose the input style. It's whether the free cash flow per share or free cash flow total shares. It depends on how you like calculating based on the number of shares, total shares, or per share basis. Let's choose the per share free cash flow. Then you choose the per terminal value period. You can put the perpetuity gross. This is the gross. For example, we are calculating the free cash flow for the next 5 years in this example. But you can choose for 10 years or 15 years and so forth. And this gross rate, it tells you by how much the company's free cash flow is going to rise after 5 years. So it usually maybe 3% or 5% depending on the cost of the money. Or you can choose the exit multiple. That is some multiple that you choose, some gross rate that you apply for the last year analyzed, for the 5th year in our example. If we are analyzing for 5 years, if you are taking 10 years, then you imply this multiplier for the 10th year, for the last year. But let's choose the perpetuity gross. Then base free cash flow per share. So this is the free cash flow we are starting from. You can go to the company's website, to investor relations website, go to cash flow statement, and then tease the actual cash flow, then read management reports. Maybe they are expecting free cash flow rise by some amount. You can read analyst estimates and see what are they thinking about the cash flow. See their cash flow estimates. That is how you can forecast the free cash flow. Then you go to the discount rate or WACC rate, the weighted average cost of capital. You discount your forecasted free cash flow in company terminal value by this rate. The higher the discount rate, the lower will be your forecasted share price or stock fair value or stock target price, some analysts call it. So what you have to do here is base free cash flow per share, since we're taking the per share basis, not based on the total overall cash flow. So we're taking the forecasted free cash flow and divided by number of shares outstanding. Let's say it's a 5 in our example. 5, it's a free cash flow per share. Then first stage is the gross rate. You separate it by comma. First, let's say that I assume in the first year the free cash flow per share will grow by 12%, then second years by 10%, 8%, third year, fourth year 6%, and 5. You can adjust it manually if you want. Then it's a 5, since we're forecasting for 5 years. Ideally, you should forecast for maybe 10 years, 15 years. You can change it in here and then add years here, add the gross rates here. For example, if you have 10, you should add here 10. Then add the company's net debt. You can take it from the balance sheet. Shares outstanding also from the balance sheet. The current share price, you can Google it, or if you're tracking some share or if it's in your investment portfolio, you can take the last trading price. And this is the perpetuity gross rate. Since we're taking this terminal value method as a perpetuity rate, we are taking this gross rate and let's put it at 3% as initially was set. So if you take the multiple here, you should use some multiple for the last year as I have mentioned. But since we're taking this perpetuity gross method, we're indicating 3% over here. Then based on your calculation, that's basically everything you have to do right here. And based on your inputs, you're inputting the cash flow per share, discount rate, gross rates for 5 years, forecast year period, net debt, shares outstanding, current price, and perpetuity growth rate. And then this calculator calculates you the target price per share, 92%, which implies 41% growth potential from the current 65%. So this is the fair value per share growth potential. And another part, the second part that this calculator is doing is very interesting. It's a sensitivity table. Well, DCF model, there are a lot of assumptions that analysts use, and it has some sensitive points. In particular, it's a terminal growth rate and the discount rate. So the terminal growth rate, you are assuming different rates for the company, and you're saying what will be the stock target price if the terminal growth rate will be, say, 3%, and the discount rate or cost of capital, the rate by which we divide the free cash flow, and then the terminal value to come up to the equity value to calculate its stock target price. These are the rates. Let's say you think that the cost of money will be rising, inflation will be rising, the cost of money will be rising in the future, and discount rate will be 10%, and the terminal growth rate will be 3%. So in this case, the company share price will be 92.25. But if the cost of money will rise even further, if the risks will be higher in the US stock market, let's say, if banks will be tightening their belts and raising the cost of money further, then you can say that the discount rate will be 12%. And in this case, the share forecasted price can be 71%. This sensitivity table is very useful because it allows you to see the stock target price under different conditions and the different cost of money and under different terminal growth rates. And by doing this, you can see the range. The higher the range, the higher the future volatility of the stock can be, and you can better manage your risk and understand where your stock target price can be. Not just fixed number, but you can use this sensitivity table and see where your price can go. Here some of the useful materials. This is very useful investor app for undertaking fundamental analysis, building your efficient diversified investment portfolio, undertaking AI stock research, so you can check it out over here. This is the sensitivity table article. You can read and understand how to use it in forecasting the share price, and this article helps you understand what is the DCF valuation model and how to use it with all the formulas. This is the first calculator that I wanted to show you, DCF scenario builder, and second calculator is the Piotroski F-Score Calculator. You can come from here in the menu and click a Piotroski F-Score, or you can go to the main page menu here and hit the Piotroski F-Score Calculator. So what this calculator does, it assigns the company 9 score rating. 9 is the highest. It shows that the company is very, very strong fundamentally. If the rating is 2 out of 9 or 3 out of 9, it's a weak company. From 4 to 7, it's a medium company. You have to examine it further and decide if you want to buy the share. No, but if it has a score of 8 or 9, you still need to examine it further, but it looks stronger in comparison to other stocks with lower Piotroski score. It looks fundamentally stronger. So there are two options of how you can use this calculator. You can input financial numbers from the income statement, from the balance sheet. As you can see, income statement should be higher in the current year than in the previous year. This is +1 point. Then the operating cash flow should be higher. Total assets should also be higher. Lower long-term debt. If the debt is rising, then you get lower point. For example, if, say, in the current year the debt is 900, now you instantly see the red sign here and you get lower score. You get 8 instead of 9. Then you see the current assets, they should be rising. If it's falling, for example, let's say 400, then you get minus score over here and you get 7 out of 9. It is already not that strong fundamentally. You can examine balance sheet, a company's income statement, examine revenue. Yeah, revenue should be higher. Gross profit should be higher than in the previous year. And by inputting those numbers, you take the prior year and the current year's financial statement. Go to investor relations website, see the company's financial statements, and input this data manually. Another way of how you can use this Piotroski score is through quick toggles. You can simply answer those questions. If the company has a positive ROA, ROA is a return on assets. If it has a positive operating cash flow, you can answer the leverage question. If there was a share dilution, new share issuance, if the gross margin improved, yes or no. And if you see, if I put yes everywhere, let's say put 4 yes and 4 no, 5 no. In this case, we see that the Piotroski score is 4 out of 9. It says mixed but stable. You can name the company here, put the company name, but I'm leaving this field blank as a sample company for this example, not to make this video very long. And if you like this calculator, you can subscribe to my newsletter and contact me via WhatsApp. And of course, you can also support me by, these are the ways of how you can support me. I hope you liked this video and you're gonna like my free investor calculators. Thank you very much for watching this video.